Hello, everybody. Chuck Carnevale, co-founder of FastGraphs, the fundamentals analyzer software tool. It is my extreme pleasure to bring you the first of our FastGraphs Value You Academy, where we're going to be teaching finance and investing through a very comprehensive curriculum. We've associated ourselves with two academics that we're very proud to be associated with. And what I'm doing here, I'm introducing the first of three podcasts where we'll be covering the introductory portion of our curriculum. And then once we get past that, we'll be providing some very exciting videos on how to read financial statements, how to value stocks, how to think about investing, and how to better prepare yourselves to take care of your own financial futures. It's all about empowerment. So at this point, I'm going to go ahead and turn it over to my son, Colton, while we view the first of three podcasts that we'll be providing for you as introductions to the FastGraphs Value You Academy.
Thanks, Chuck. Before we get started, I just wanted to go around and let the whole panel introduce themselves for everybody who's new here. So to get started, my name's Colton Carnevale. I'll be moderating this conversation that's going on. And why don't we go with Chuck?
Thanks, Colt. Yeah, I'm Chuck Carnevale. Of course, many of you know me as Mr. Valuation. I'm the co-founder of FastGraphs, the fundamentals analyzer software tool. And I've got numerous articles published on various financial blogs. And I'm very passionate about helping investors become smarter, more prudent investors over the long run.
Bill, how about you?
Yes, William Kay, and I have my own training and consulting company. I've worked with universities and colleges and large corporations teaching finance and accounting for many years, and it's kind of my passion.
And Nathan?
I'm Nathan Mock. I'm a finance professor at the University of Missouri, Kansas City, and I teach classes on valuation and corporate finance, and my research is focused on the same topics.
Awesome. Thanks, guys. So the first question that we have today, Nathan, I'm going to kick it to you first. Regarding investing in the stock market, is this gambling or what?
It's a good question, and a lot of people make that analogy to compare investing to gambling. And I'd say there's some similarities, but there's some big differences. And the big difference is when you gamble, the house always wins. And so the expectation when you gamble is that you're overall not going to win playing house games. But the stock market tends to go up. If you look at the historical returns of equities in the U.S., they're pretty strongly positive over long periods. And so there's a lot better chance to win at this. And I'd also say that the gambling analogy sort of suggests some luck. And certainly there is some luck involved in investing. But there's also a lot of skill and process and logic. And there's a way to really help your chances to do well in the market by understanding how valuation works, how companies work, and how the stock market functions. So I think there's some similarities, but I think there's some really big differences. And there's a lot you can do as far as just empowering yourself to make decisions by learning the right kind of content.
Yeah, I would have to agree with Nathan very much there. You know, knowledge is power. And one of the things about positioning yourself as an investor or as a gambler, a lot of people look at the market as a big casino, and that tends to be kind of short-term oriented, where, you know, it's an auction, they're playing the bids and asks and that kind of thing, where the true investor is kind of looking at it from a business perspective standpoint. And we'll talk about that more in a few moments. But the idea is if you're positioning yourself as a long-term owner of a business, the short-term gyrations of the market don't really affect you as much as if you're obviously trading, and then every little tick of the market kind of creates some angst and anxiety.
So, Bill, before we hear from you on this question, I think it would be good to just tie it in with another question that we have, and kind of combine both responses. So, along with, is this gambling or what? Is it worth really learning about investing, or should you just be letting your advisor do it for you?
My answer to that is it depends. I really feel if you have the interest, a little time, you should do it yourself. I personally love to control my own investments, my own money, and it's rewarding to see it grow over the years. And if you pick great companies and you stick with them, time is your best friend. Personally, I reinvest my dividends, compounding. It's been a great tool for me and my family, and I love to teach it to other people.
So, but even if you don't have the time to learn or to necessarily even manage your portfolio, wouldn't it be a good idea to at least understand the fundamentals of what's going on in the markets and, to be able to grade your investment advisor?
Oh, absolutely. I mean, financial literacy, financial acumen, I think it's necessary. My feeling and passion, it should be taught in schools starting at a young age. People should understand how the markets work, how business works, understand how to read the scorecards of a business or financial statements. I think it's very important to everybody.
And, Nathan and Bill, perhaps either one or both of you might be able to give us some more precise detail, but I've seen numerous studies talking about the long-term returns that mutual funds actually generate compared to the returns that people that invest in mutual funds earn. And the people that typically invest in the funds tend to earn a lot less than the fund actually generates because they tend to go in and out too much. I always like to say a portfolio is like a bar of soap. The more you handle it, the smaller it gets. And people tend to be impetuous. And, the knowledge is power, and the biggest risk we face is fear and greed. And the biggest antidotes for that is knowledge. If we understand what we're doing, we can avoid the temptations to react. I don't mean act, but react to what might be going on in the market that's not always rational. We also need to accept that fact.
It's a great point, and related to getting advisors, whether you decide to allocate your money yourself or use an advisor, some combination of the two. Even if you go 100% with an advisor, you still have to pick the picker, so to speak. You still have to decide on an advisor, and you got to have some way to evaluate those folks and understand their process, and also advocate for yourself and talk about what your goals are. And I don't think if you don't take the time to really understand how investing works and to really identify your own priorities, it can be hard to really get the right kind of advice and the right kind of products that you want. So I think even on that extreme of things, if you really don't want to take a real active role, it'd still be helpful to know. And I think a lot of people are surprised that it may not be as time consuming as they think if they have the right data and the right information to manage a portfolio. It's probably a little more easily accessed than I think most people would guess.
So I want to keep talking about both concepts of doing it yourself and also being able to grade an advisor. And Chuck, you brought up earlier in what you just said, you brought up mutual funds. And there's a consensus out there about mutual funds and ETFs that if you don't really know what you're doing, you should just throw your money in some sort of fund and some sort of, index fund and an ETF. That way you can just get a large amount of stocks pretty quick and kind of move with the market. So regardless if you're doing investing on your own and managing your own portfolio, or if you have an advisor managing your portfolio, Nathan, I want you to answer this question. Do you want to own winners and losers or just winners? And I specifically want you to touch on what happens when you invest in some sort of fund or an ETF.
Sure. One of the most popular innovations relatively recently is index funds that track something like the S&P. And then you own, on a valuated basis, all of the S&P firms. And so that is tracking the market. And these products tend to be pretty low fee. And I'm a big fan of low fees, certainly. However, when you own an index, you own all of the firms that are poised for success and all of those that are maybe not so poised for success. And I like the recent pandemic as a good example in terms of once it became clear sort of what we were looking at with respect to the impact of the economy early on in the pandemic, there were some firms that were going to be pretty obviously better suited to get through that, and some firms that were really going to struggle. So think about firms like in the hospitality sector that would be really disadvantaged by that. And when you own an index, you own both. You own that group that almost anybody would look at and say is going to do well, and almost anybody would say is probably going to do poorly. And if you want a little more control to tilt towards winners versus losers, or what you think will be winners or losers, then you're going to have to do that outside a product like an index fund. And that's would be kind of my main takeaway there is there's nothing wrong with getting market exposure and, reducing some of the homework potentially, but valuation still matters with an index fund. The right index at the wrong price is still not the optimal investment. So it's not quite as simple as it might seem just to dump your money in an index and kind of walk away.
Yeah, I want to just echo that and comment on that last point that Nathan made. There are certain times that you want to, an index fund could be an excellent investment. And there are actually times when you don't want to buy the whole market. Valuation matters in an index just like it does individual stocks. And just like I always say, it's a market of stocks, not a stock market. The same is true as indexes. When you're looking at even things like the Schiller, CAPE, and everything that these guys can talk about more than I can, when these indexes are trading at all-time high valuations, that's not a good time to be getting in. And right now you have that case, for example, with the S&P 500. Bill, you have anything to add to that?
Well, I always look at risk and reward and diversification. And what I tell a lot of people is if you're not earning at least a 2% return on your money, you're not staying up with inflation. So your dollar is going to be 98 cents in a year, or maybe even less, because we're talking inflation is going to be growing with what's going on in the world right now. So I believe in safe diversification with great companies, but you've got to have your money working for you. And if you put your money to work in the right areas and see it grow, that's really what it's all about in my mind.
So staying with index funds though, and being able to invest in the market, let's just take the scenario and assume that we can get in some sort of index fund right now that is at a good valuation. So if you can get in an index fund that is at a good valuation, is it worth adding that as a position in your portfolio? Or should we still be focusing on individual stocks and really trying to get only winners and not the market as a whole?
Personally, I don't think there's a right or wrong answer to that question. I think it's really an individual,
it depends.
Makeup of the person. Right. Exactly.
Mm-hmm.
Gotcha.
Yeah, it really does depend on your situation and so forth. I mean, you don't want all your eggs in one basket. Maybe you want to spread them out, but
right. I guess like if your personal portfolio that you're controlling was pretty heavily invested in one sector, then it might be smart to invest in an index fund if the valuation is, deems it allowable.
It's true. I also think that sometimes an index fund or ETF that might track a sector, even the broad market, is a good default if you can't find obvious winners. If you don't have a lot of conviction over some individual stocks, it's a way to keep your money at work if you can get it at the right price. And you don't have to get quite as particular about picking the best winners within a sector or even a broader market. But if you have a clear idea on what you think is going to be a winner, then I think that also makes a lot of sense and can be a part of a really robust strategy.
Great.
All right. Thanks, guys. And then Chuck, question for you. And, this may be, for people who know you, this would be a pretty obvious answer, but are you a short-term or a long-term investor, and why?
Well, obviously a long-term investor. I think one of the important principles of investing is time in the market. And we've kind of alluded to that rather than trying to time the market. Markets can be quite irrational. They can do crazy things. And there's even a lot of discussion in the academic world that talks about the efficient market and the efficient frontier. I've always been a believer the market is not necessarily always efficient. In fact, I'm virtually positive. I think Buffett once said, if the market were always efficient, he'd be a bum on the street with a tin cup, I think is how he put it. But the reality of it is, in the long run, as Nathan also alluded to, markets tend to go up and, they do well, but there will be short times when they don't. So it's really important to be positioned for the long run. Also, I think the most critical part is, I have a saying that says earnings determine market price in the long run, emotions drive market price in the short run. And if you're investing in a business, it almost implies that with a business perspective, which we'll talk about more, it really implies a long-term ownership because a friend of mine used to say, companies only report their earnings quarterly or 4 times a year, whichever comes first. And the point is, it takes time for a company to grow earnings and generate dividends and, increase their cash flows and their revenues. And you've got to give the investment that kind of time. In the short run, there's going to be a lot of gyration. Stocks are going to, be volatile. They're going to go up. They're going to go down. Piece of news is going to come out. People are going to get scared. They're going to get greedy. But in the long run, fundamentals ultimately rule. And fundamentals are a function of having enough time to let the business actually make you the money and not try to rely on, emotionally driven stock prices to do it instead.
Before we open this question up to you and Bill and Nathan, I wanted to kind of expand on that. So when we're talking long-term though, obviously we can't be expecting returns to just start hitting our portfolio immediately on day one. Like you said, it takes a little bit of ramp up time for an investment to start taking place. But how long is long-term? I mean, is that 20 years or should we be looking at it for every couple years?
The answer to that is kind of general. There is no specific answer, but there is kind of a general answer. To me, it's a business cycle, and that tends to run 3 to 5 years. And, we're going to be doing a talk. We already done an intro video on the power of compounding. Compounding is all about compressing time, for your money to grow, where you can grow your money faster in a shorter period of time by getting a higher rate of return. So to me, it's 3 to 5 years minimum. But, like Warren Buffett also once said, the best holding period is forever. And I think you have to approach investments that way. Now, sometimes you have to use judgment. Sometimes things get really out of whack and you might be required to sell or fundamentals deteriorate. There are things that will change that, but that ought to be the original ultimate objective. The longer, the better, but at least a business cycle, because you want to give the company time enough to generate the additional value that you believe the company is capable of giving you through the operations of a business. And that doesn't happen in one quarter or even, 1 year. That usually happens over a span of years.
Bill, what do you think?
Oh, I agree totally. I look at day traders in and out, and that's definitely not my style. I like to hold great companies and watch them closely. And if they're giving me back a return, great. I continue with them. Things do change. Great companies can go south. You look at what happened to Sears. You look at other great companies, and there's a time maybe you want to get out and move on. So you have to keep your eye on the ball.
And Nathan, what about you?
Yeah, so a couple of thoughts I have on the long term. One, I just echo what Chuck had said, that in the long term, cash flow determines price and value. So it's the firm's ability to generate cash is what drives their value, and eventually price will bear that out. But that isn't always necessarily true in the shorter term. And so if you want to benefit from cash flow growth, then you really have to hang around. And the other thing I'd say is there's research out there that shows the consequences of missing the days that where the most upward movement takes place. And, it's a stiff penalty if you miss those periods where the market makes these runs. And so thinking that you can get out and avoid the bad times and jump right in at the good time is usually a fool's errand. It usually doesn't work out. It's better to stay invested in the type of company that you feel comfortable owning for a relatively long period of time. It prevents you from getting into a panic sell type of situation where you're selling at exactly the wrong time.
I know in my own personal investing, I always like to treat stocks as kind of like, I bought something, like I bought an iPhone. I don't really treat it as a value of money that I'm worrying about day to day. I mean, obviously, like you guys are saying, there's some times where you need to get out, but realistically, I think going off the idea of long-term investing, that people need to realize that there's going to be ups and downs with stock price movement. And as long as it's a good company, you basically just need to hold on and ignore the current market price and what could be happening today or tomorrow. Nathan, you brought up cash flows, and Chuck, you said earlier in the chat about, business perspective investing. So I kind of wanted to open up the conversation towards that. So what is business perspective investing, and how does someone manage the risks of investing?
All right. Well, that's obviously a good question. And really, to me, it starts with a mindset. Are you looking to become a shareholder, owner, partner in a great business, as Bill alluded to, or are you looking to, speculate on market variations? So to me, it's thinking like a businessman. When you buy a business, I don't think anybody ever buys a business. I think I'm going to own this for an hour. I'm going to own it for a week, or I'm going to own it for a month. You say, hey, this is a business that I think can, give me good returns, can generate me good money over a long period of time. Now, there may come a time when you, for personal reasons or whatever, you decide you want to sell that business. But typically you make the investment for the long time. So business perspective investing means think like a business owner, think like a partner, and focus on the fundamentals of the business that you own a lot more than you do, what's happening in the short-term prices, whether the price is going up or down. I think Warren Buffett did a really great analogy of that once. And I don't remember the publicly traded stock, but he said, I'll use Coca-Cola because that's one of his big holdings. That's not the one, but he said, the difference between me investing in Coca-Cola and the farm I bought in upstate New York, he said, there was no, excuse my language, damn fool coming over the fence of my farm every day yelling bids and asking to buy or sell my farm. And I think there's a lot of truth to that, because those constant barrage of bids and asks of people buying and selling tend to either tempt you or make you nervous or whatever, where, if you actually own the farm, it's a matter of letting the farm appreciate over time, because again, it's the time use of money, time in, not timing.
Nathan, what about you in, business perspective investing?
Yeah, I think it's a great point. And, whether you own just a very small fractional share in an entire business, it's fundamentally pretty similar. And I think it makes sense to treat it like it's fundamentally similar. Mm-hmm. And, sometimes because we can take on a dollar basis relatively small investments in a publicly traded company, we lose sight of that. But it's still the same things. If you're going to buy the whole business, you'd want to check out, is it a stable company? Do you like the management? Do you like the industry they're in? Can you get it at a good price? All of those types of things that you would ask. I think most of us have an idea of what a good business looks like, a healthy business looks like. And we can always learn more on that. But, really taking that approach to investing just gives you a great place to start with, to work through the process logically and get you hopefully the best kind of allocation you can find.
So, before Bill answers or comments, I do want to make one of the common questions I ask people I have over the years is, do you understand finance? Do you understand investing? And they always tell you no. So then I follow up and say, do you understand what a profit is? And they always tell me yes. And I say, well, you now know everything you need to know about being an investor. That's really what it boils down to.
So, Bill, before you answer that question directly, I kind of want to spin the question a little bit for you. Nathan mentioned that we all kind of know what a good company looks like, what a healthy company looks like. But for the people that don't really know yet, who are just getting into investing and are listening to this, could you describe, I know it can get complex, but let's do like a top level approach. Could you describe some healthy characteristics of companies to invest in and what to look out for?
Yes, in my mind, number one, products and services. What is the company? Every company has to have something to sell to a customer. So what are their products and services? Is there a demand for it? Am I using it personally or other people that I know? That's kind of number one. Number two, the management team. Who's running the company? Then you can look at their track record. What kind of a return on investment are they giving to people? A return on equity. Are they generating an accrual profit? Are they generating cash flow, as we talked about? What's the trend? As Chuck said, you want to look over the 3 to 5 year trend. If you see those things and it's a great company that you think is going to prosper into the future, those are the ones you really want to investigate. And maybe you stick your toe in the water, put some money in, watch it, and you increase that dollar cost average in and stick with it over the long term, as long as they're giving you back a return. It's always about a return.
And Chuck, what about you? What do you look for a lot of times and, kind of decide what looks like to be a healthy company?
Well, there's all the cliches. Like I think it was Will Rogers that said he's always interested more on the return of his capital than on his capital. So you want to see things like if you're looking for dividends, you want to see, are the company's cash flows covering the dividend? Are they earning money? How consistent is the earnings growth? There's a little more risk in a very cyclical company versus a steady Eddie like Johnson & Johnson. Like Bill always says that, Johnson & Johnson isn't AAA rated for no reason, So I like to focus on the cash flows. Now, all those other areas, the margins, the return on equity, returns on assets, revenue is critical to me. Is the company actually bringing, in good revenues? Then, of course, are the company bringing it to the bottom line? You want to look at things like debt levels. So there's all the nuances, but none of those things are really beyond the purview of most people if they have just a little bit of common sense and understanding of business and all. And I think that's really the important message here. What our goal is going to be with this academy is to help you understand those things a little clearly and probably help you realize that you are capable of understanding those things, that it's not, voodoo or rocket science necessarily. It's pretty straightforward, common sense based stuff.
And Nathan, how about you? So, what are you looking for as a healthy company? And what are you looking for to tell the difference between a good and a bad stock, essentially, a good and a bad investment?
Yeah, Bill and Chuck really nailed it with what they said. The thing I would just add to it is you can't invest in what a company has done. You can only invest in what's going to happen. And so their track record can help us a lot. That's a great tool to help us evaluate. But, we really want to focus on those firms that have the best prospects. And so that also helps explain a lot of interest in some of these really high growth stocks that may not be generating profit, but people get excited about and have generated some pretty good returns recently. It really is forward looking, the ability to generate cash, not necessarily just that they have done it in the past, that they're going to be able to do it. And I think that does fit in, like Bill said, to the products and services and trends and the industry that they're in and that firm specifically, and absolutely to the cash that they're generating. So
awesome. Well, I think those are all the questions we have for today. So I just wanted to open the floor before we close this up for any final comments that any of you might have.
Well, I'm just very excited about working together and putting this together, and I think it's going to add a lot of value. And I know FastGraphs has been a wonderful tool for me and helped me very much in the past, and I look forward to working with all of you.
Yeah, I can't even, echo that any more than what Bill said there. I'm very excited about the curriculum we have. I think you're going to find it be very fascinating and enjoyable. We've got a long journey ahead of us, and we've got a team here that's really enthusiastic and excited about sharing all this knowledge with you. And by the way, learning from you as well. I think this will be interactive as we go down the road together.
Yeah, I'd just add to that one of the things that I really like about FastGraphs is the ability to see a lot of this stuff. So it gets a little, sometimes the talk about, what makes a firm healthy or, cash it's going to generate gets a little abstract. But with FastGraphs, you can visualize what that looks like. And that just makes the decision-making process of investing so much simpler and clearer and less time-consuming. And so I think the combination of information and tool are just such an exciting combination, and I'm looking forward to continuing this.
Awesome.
Totally agree.
Well, I think that's it for today. So just so everybody watching this knows, we are thinking of doing a couple more of these videos, kind of going through the workbook that Chuck showed earlier and answering some top level questions. So definitely let us know in the comments what you guys think about all of this. And don't forget to like, share, and subscribe. It really helps the channel grow. And thanks for watching.
See everybody soon.
Bye-bye. Thank you.